Hello, everybody. Thank you so much for joining us this afternoon. My name is Samantha, and I'm in client services here at the Retirement Group, and I'm going to be moderating this webinar for you this afternoon. You're going to see me throw some very useful links into the chat. They're what I consider our most valuable resources. One will direct you to our Fortune 500 retirement guide, as well as an online education center where you can view all of our past webinar recordings. And then you'll see a link to LinkedIn where you can follow us for updates on future recordings, as well as a link to book an appointment with an advisor after this presentation. Today, we're going to talk about market fluctuations and potential recession. If those two things have you a little concerned about your 401k, you're in the right place today. Our speaker, Wesley Boudreaux, is going to be offering valuable insight on investment strategies, focusing on company value over stock price. Before I bring Wesley on, I have to just remind you that although we work very closely with both active and retired members of Fortune 500 company communities, we're not affiliated nor endorsed whatsoever by any specific company. The Retirement Group is a completely independent group of financial advisors. So we just want you to keep that in mind. As well as I would just like to let you know, after Wesley's presentation, I will be coming back on to ask him any of the questions you may have entered into the Q&A box throughout his presentation. So feel free to enter those, please. We keep it 100% anonymous, and he'll answer as many as possible after his presentation. And with all of that boring stuff out of the way, I'm going to introduce you to our speaker today, Wesley Boudreaux. Hi, Wesley.
All right. Thank you for the introduction. Hope everybody's doing well today. As you mentioned, we're going to be talking about kind of market volatility a little bit, but more importantly, kind of talk about the Retirement Group's investment philosophy and our perception as far as following value over growth a lot of times. Now, obviously, there's going to be a combination of those approaches when it comes to investment strategy, but we'll dig into some of those, kind of educate you a little bit as to where we see value as a good fit in a long-term portfolio and how it also reacts to our current inflationary environment we're going through as well. Before I get started, a quick reminder for those of you who do not know who we are. We have been working with Fortune 500 companies for a little bit over 30 years, helping employees transition into retirement. Our goal there is to work with a select number of companies, so our advisors like myself and others across America can get a deeper understanding of your specific benefits plans, whether it be your pension, your 401k, your healthcare, retiree, medical, life insurance planning, all those different aspects. So we can actually kind of hold your hand through the transition process. Hopefully we get a hold of you or talk with you, 5 years out of retirement, so we can help you determine the best day to retire so you can maximize all your benefits from your company specific plan. And we do have offices throughout the country, so rest assured if you need to sit down with somebody face to face, we can probably still accommodate that. But obviously this day and age, since the pandemic, it's been a lot easier to have one-on-one conversations via Zoom or webinars, obviously phone calls, emails, whatever your preferred communication is. Don't hesitate to let us know. But at the end of the day, whether you work for the company we know a lot about or not, it doesn't matter. The end of the day, the best thing to have a deep understanding of what your retirement process looks like and your investment philosophy is to run a detailed cash flow analysis. That's essentially a financial plan, taking a look at what your situation is. You give us your desired retirement date. We can take a look at your built up assets, your 401k, your pension, what Social Security is going to be, what longevity looks like, and go through all those different aspects to figure out, are you on the right path to meet your retirement goals of maybe retiring in 2 years or 4 years? We can look at deviations, whether you want to retire earlier, whether you want to retire and go take a different job, maybe focus on quality of life versus quantity of dollars earned. But also for a lot of the companies we work with, a lot of this comes around in the pension selection option as far as when do I select my pension, looking at lump sum versus annuity, things of that nature. So any questions, just go ahead and reach out to us on that. If it's been over a year or so, reach out to us again, because obviously a lot has changed. Let's get into what we're going to talk about today. And this is more of our value presentation. We've been talking about this for a while, and a lot of these slides are the same slides we had back in 2020 when we were really pushing this coming out of the pandemic. So some of this will be a little bit of regurgitation, but ultimately speaking, we're going to focus on the fact that high government spending, which at that time was pretty high coming out of the pandemic, we had spent more inflationary adjusted dollars on the pandemic than we did of World War II, believe it or not. And then tack onto that some additional spending that's happened over the last 2 years. Obviously, the assumption is that eventually that's going to have to lead to higher taxes at some point. Time will tell, administrations will tell as well. We knew it was going to lead to inflation. Did we expect it to be as severe and as quick as it was last year? Probably not. But again, the writing was on the wall. We knew inflation was coming between the combination of the bottlenecking of things and also the just the free flowing cash that was thrown around by the government. And what that's going to do, it leads to the higher inflation leads to higher interest rates, which also can lead to different investment opportunities. And we'll talk about that on the stock side. Obviously, there's differences in the bond side as well, which we have conversations with one-on-one when we go through there and focus on the investment planning with our clients and prospects we've worked with as well. So some of the things that capitalize on the market slowdown, we've seen this kind of ebbs and flows. We saw a severe pullback last year, 2022, bit of a rebound pullback. We're kind of going back and forth right now. But we'll talk about our philosophy of value. We'll give you an example of value, maybe not necessarily related to the stock market, but give you kind of an idea to understand, what value means as far as investing in a specific company. And then we'll talk about the differences between value and growth, kind of the historical performance and going forward as well. So first and foremost, let's kind of educate you on what value is. The ironic thing is, I think most of us, maybe not all of us, but I think pretty much 90 some odd % of us are value shoppers when it comes to just looking at things from a day-to-day standpoint, or when we go out there and buy something. We need to just kind of correlate that into our investment philosophy or find fund managers that can do that. So if I'm gonna go out there and I go grocery shopping, I'm not necessarily gonna look for every single coupon or the cheapest thing, but I want to make sure I get the most bang for my buck. If I'm gonna buy a car, I'm probably gonna shop for it. I'm not just gonna go buy the most expensive thing out there or the flashiest thing. I'm gonna look for a deal. I'm going to scour and try and make sure it's the most value for me. Same thing, go and buy a dress, buy a TV. Most of us tend to shop. That's the same way we need to look at investing in stocks, whether you're doing things on your own, buying an individual stock or buying at least 20 plus to get diversification, or looking at finding investment managers that have consistently done this for the last couple of decades, or at least 2 decades or so, proving that they can do so. So what happens when we look at a value company, we focus on the price to book and the price to earnings ratios. We focus on companies that have higher dividends, so typically companies that have cash on hand, where they've got the ability to essentially weather the storm. They've kind of gone through that growth phase and they've gotten to the point where it makes more sense to pay out dividends to individuals or shareholders to reinvest on their own, because they can't generate that high growth anymore. But what happens is that creates stability in there. It also helps us to develop a margin of safety and ultimately lead to a reduction in permanent capital loss and reduce your downside risk. So if I were to go out there and say that I'm taking a look at a company and I think that company, with all my research, is worth $100 a share. And if it's out there trading at $80 a share, then we already know it's below that intrinsic value. So we built in a margin of safety in there. So again, we'll talk a little bit more about this, but ultimately, from the scheme of things, when you're comparing apples to apples, a value company tends to be a little bit safer over the long term than what a growth company is going to be. So let's take a look at the historical, past, let's say the last 2 decades, if you would. This chart's going back 2000 to about 2020, so it's not 100% updated here with some of the changes. But if you take a look at this, I might want to zoom in and make it easier for you to see. But that purple line is going to represent the value, and the blue line is going to represent growth. And what we saw coming out of that dot-com crisis, we saw value outperform growth all the way through the recession of 2008, 2009. Once it bottomed out in 2009, then obviously everybody started chasing for the fences again, and growth started to outperform. And it has been doing that quite significantly for a long time because we've had extremely cheap money. So what happens is a lot of times growth companies, they're fueling their growth by borrowing. And so our fears were, when we showed this chart back in 2020, that eventually we're going to see value outperform, because what's going to happen is inflation is going to drive things up. It's going to get more expensive for those growth companies to continue to fund their ventures. And not necessarily that everything's going to go up, but what will happen is value will outperform, relatively speaking. And we did see that in 2022, and we've seen the flip side here in 2023. But let's take a look at kind of year over year, going back a little bit farther to show you the differences between these performances. So this is going all the way back to the mid 80s or so. And you can see when we had higher interest rates, we actually had value outperforming. Then things got a little bit cheaper. Growth started outperforming. Then value outperformed again. And then we got to kind of that dot-com era, the late 90s, where growth just took off. On that flip side, we saw that crater and we saw that pullback in 2000, 2001, 2002, and we saw value outperform quite a bit. And what we've seen since then, growth has been the key outperformer, but it has had a couple of years in there where value started to outperform a little bit better. But going back to what I mentioned before, this is, you can look at things as a 50-50, half growth, half value. You can overweight one or the other depending upon where you're looking at things. But at the end of the day, value has consistently outperformed, but both of these are not too far apart. If you look at the long-term performance, on the short-term side, that's where you want to focus on looking at what's happening in the economy, how's this going to affect things. So again, we're focused more value, in 2020, 2021, moving into this in 2022, value extremely outperformed growth. I think if I have to go back and double check, but I think, growth was down about 30% in 2022. Value was down about 7% or so. Flip sides happen this year so far, year to date. Growth has started to outperform because again, people have chased those losses in some cases, but we'll see as time goes on. But ultimately speaking, again, we believe that value, a little bit overweight there still right now with higher inflationary pressure and higher interest rates, is going to be better over the long term. Charlie Bobrinskoy, Ariel fund manager, a great quote from him. If you go back to 1926, value has beaten growth every 10-year rolling period except for the last 10 years. So again, hindsight's 2020, or past performance is never indicative of future performance, but historically this is what's been happening, especially kind of 1970 through 2007. Value extremely outperformed growth over that time period, but again, since that last recession and that rebound, we've seen growth outperform. So at that point, there should be a correction, if you would, or a mean reversion, is what we're looking for, especially with these higher interest rates. So let's go through an example. Let's not assume that it's an investment company. Let's assume you're trying to buy a company on your own. How would you approach this to figure out if it's a good value or not? So let's assume maybe you retired. You've been retired for a year or two, and you've gotten bored. You want to go out and do something. Maybe you've gone and you found this flower delivery company that you want to purchase. But instead of just jumping in there and purchasing it, you need to review things to see if it's actually a good investment. So let's take a look at this. Let's assume that the cost to buy this business is $200,000. The book value, which is the assets minus the liabilities, is going to be actually about $170,000 because they've got 5 delivery trucks on hand. Of course, that's a depreciating asset, but 5 delivery trucks worth $160,000. They've got inventory worth $10,000. And it spits off $30,000 in net income a year. But from that, I guess the previous owner looks like they're keeping $24,000. So if you look at this a couple different ways, this would probably look like a pretty decent buy, assuming you want to do this business, because there's that aspect of it as well. But you're putting in $200,000. You've already got a value of $170,000 in there. If it makes $30,000 a year, you get back your $200 within about a year. Or you can look at the fact that this individual, the previous owner, is taking 24 grand off. You're putting in $200,000. That's a 12% annual rate of return, which is pretty good. So again, we're giving this example as a way to think about. Obviously, it's more complex, but when you or a fund manager goes in there and looks at an individual company, this is how they do it. But get a little bit more detailed focus on there. So the difference is, it's also good to focus on managers that have consistently done this and outperform, because it's very tedious and cumbersome to go in there and try and research a company. And then obviously information is changing. It's flying around all day long. And if you want to truly diversify portfolio, you got to do this for, at least 20 plus different stocks. And to get those 20 you like, you might have to go through 50 to get to that. So again, that's where it comes into a conversation with us and digging into the details as far as what you're looking for. So let's talk a little bit more about the government spending. Obviously, we mentioned coming out of COVID, we spent quite a bit of money, and then we've spent quite a bit more since then. So what that's going to presumably lead to is going to be, higher inflation, which we've already seen happen, and potentially down the road, higher taxes. So let's talk about how some of this kind of plays into the where you can capitalize on events right now. So the opportunities are how to capitalize. What's uncomfortable today. We'll talk a little bit about a value investing philosophy, having to kind of weather the storm in some cases and be okay with uncomfortable situations, and what's your overall end goal. So if we look at how to capitalize on these opportunities, first and foremost, you want to take advantage of price volatilities. Now, that doesn't necessarily mean you do it, but you want to focus on managers that may do so. Let's face it, today, the last 10, 15 years, the technology has caught up to us, and It used to be that there was a lot of, lag, if you would, in information. So a lot of times the fund managers and those, traders and those in the know could get some differentiation material there, and they could actually, do better by having information more readily available. Now, pretty much everything's on everybody gets the same thing every second of the day. The question is, how do what do you do with it? How do you do it? And do you trust it a lot of times too right now? So you want to focus on potential price volatilities that come and go throughout the course of the year. Take advantage of market irrationality. So a lot of times what we'll see is the market, and because we are emotional people, we will overreact. And you'll see that market kind of swing in pendulums. It goes to the left and right, or up and down, if you would. And a lot of times it overshoots where it should be. So a lot of times there's some irrationality there and some volatility options you can take advantage of there. And don't get caught up in her behavior. So again, if everybody's doing the same thing, doesn't necessarily mean it's the right thing. And I'll take this a step further. Not with just investing, but also with a lot of the Fortune 500 companies we work with. We see, unfortunately, a lot of layoffs or mass exoduses where there's changes in interest rates, which cause people to want to leave and take advantage of lump sums and things of that nature. A lot of times, our herd mentality gets you caught up in that as well, where you might say, "Gosh, everybody's leaving. It's time for me to leave too." But if you really look at the numbers, you might just stick around for 2 or 3 or 4 more years or something like that. Or on the flip side, it may be everybody staying, but it may be beneficial for you to go. So same kind of thing when you look at investments. Don't just follow the crowd. Make sure that you kind of understand what your goals are and work specifically to meet those goals. And be patient. Don't be greedy. So again, a lot of times we talk about the ebbs and flows of value versus growth. Again, we're not saying everything needs to be 100% value, but if you are maybe overweight value, you might trail growth at some different times. But like I said, over the long term, historically, it's outperformed it. So be prepared for ups and downs. If you got growth versus value, yin versus yang, there's going to be an opposite. They're not going to be the exact same every single year. So you are going to have ups and downs, and you just need to kind of factor that in there. But if you've done your research and you're buying something that's on value, that's on sell, then eventually over time that intrinsic value will realize itself if you've done your due diligence, or the investment advisor or a manager has. And then again, like I said, find managers that do this, and also find managers that hold cash. This is really big. A lot of portfolios or a lot of mutual funds may have a restriction where they need to be 95 or 97% invested. So you could have a manager that might have a crystal ball and might know that everything's falling apart in 2 days. And with their own money, they're going to move everything to cash. Now, obviously, we don't recommend moving everything to cash at different times, but what happens is that person, even if they knew exactly what was going to happen tomorrow or next week, they still have to stay 97% or 95% invested in that fund. We're more comfortable with funds that have managers that have the ability to hold cash. They might be 5, 10, 15, 20% cash if they're looking at the markets and realizing, hey, there's nothing worth buying right now. We're not just going to buy to buy. So a good example is going back to the summer 2008, where a lot of the managers we use were sitting on a little bit heavier cash because there wasn't anything worth buying right now. Not because they necessarily knew that the market was going to fall apart. There were it was some expectations there, but there was nothing worth buying. So when the market did fall apart, obviously they were susceptible to it, but not as much, only 80%, and that allowed them to have cash on hand to buy things on sale. So keep that in mind. You want flexibility within your management system as well. So talking about comfortability and some of the things that are uncomfortable, to potentially decrease your risk, you do need to invest in items that are on sale. I just kind of mentioned that. Example of summer 2008, you might have been trailing, it might have been uncomfortable, but fast forward a year, you would have been pretty happy with what you did from that standpoint. On sale items may cause periods of discomfort. We just kind of went over this. You want to accept that discomfort in order to enjoy the solid long-term growth from a value portfolio. So again, like I said before, we're not saying everything needs to be value, but whenever you focus on adding value or an increased percentage of value to your portfolio, especially rolling into retirement years or in retirement years, you've added a little bit more safety and potentially more long-term performance, but also less fluctuations as well. So again, kind of go through the goals we talked about. History has shown the best time to retire is actually when stocks are on sale. Obviously, we can't peg this, but let's say that the best time to retire would have been March of 2009 when the market was at a bottom there. Or it could have been also a great time to retire, during the pandemic because the market had taken quite a quite a hit and you're able to rebound. We had a pretty big sell-off last year. So again, the question becomes, we can't really time this, but we need to focus on the investment philosophy and focus on sequence of returns too, because we can't really get the best time to retire would be the bottom of the market. Worst time to retire would be the top of the market. But again, this gets into that financial planning and cash flow analysis I talked about before. And then this one, we actually can probably put a line through this one because it's a little bit older, but we were always talking about inflation risk. Obviously, that's come to fruition already. But we talked about current dividends from a lot of stocks actually paying more than bond interest. Now, with the interest rates rising up, we're starting to see that level off, and in some cases, bonds paying more. So you're going to start seeing more of a flight to bonds over the stocks in some cases with cash on the sidelines. That's another conversation to have with your advisor if you give us a call as well. And just at the end of the day, manage your emotions and you will be financially rewarded. So again, but all this comes into focusing on the long-term play. And the best way to do that is to run that cash flow analysis or financial plan I mentioned at the beginning. Right now, about 3/4 of Americans over 50 don't actually even have a written plan in place. If you can spend, if you got all your ducks in a row already, if you can spend as little as maybe 5 to 10 minutes with us, or maybe 20 to 30 minutes, we can gather all the data needed in order to actually put together a financial plan. It gives about a week or so to get that report put together for you. And we'll sit down with you and go through that report, let you know where you stand and let you know where some things may need to be tweaked. If you have questions on your investments in your 401k or maybe outside assets, you want to see, hey, do I have value in my portfolio, or what's my value versus growth mix? Am I too aggressive? Am I too conservative for what my goals are? Just let us know. We can get a copy of a statement or a list of holdings. We can run that through our screeners and set some time up to go through an investment review with you as well. But usually those two go hand in hand. It's really good to get that cash flow analysis to find out what you're trying to solve for, and then back into what's the appropriate investment strategy to do so. So again, be very careful. If you are retiring or you're working with a broker and they don't know what your long-term goals are, then you need to kind of focus on that cash flow analysis and make sure everything lines up with what you're trying to achieve. All right, hopefully that covered some of the different items. Did we have any questions come through?
Hey, Wesley, sorry.
Okay.
Yes, we had a few questions coming through.
Okay.
The first is, can you explain why value stocks seem to do better than growth stocks when there is a lot of inflation? Okay.
There's a lot of different variables to this, but one of the things as far as just think about what growth stocks are versus value stocks. A value stock usually was a growth stock at some point. They started a business, they grew it, they borrowed money to invest to grow that, and eventually they got to where they kind of slowed down and everything became kind of I don't want to say cruise control, but steady. And so they started still generating revenue and income, but instead of investing in the company to grow it, they've hit their capacity, so they're paying that out in dividends. So on that flip side, that growth company could be that same value company that was 20 years ago. If they needed to borrow money to go out there and build that company or continue to grow it and get to that next level, then inflation setting in, the borrowing costs are a lot higher. So that's why what you saw last year since the pandemic and prior to that, since 2008 recession, we saw interest rates kind of the lowest we've seen in some time. So it's very cheap and easy for a company to go out there and borrow money, and then you tack on the private investment equity that's been thrown into the mix as well. Cash was cheap, so it's very easy to grow. But once cash started getting more and more expensive, that's where you saw kind of a hindrance on those growth companies, whereas a value company had cash on hand. They're able to weather the storm. They're able to continue to reinvest in themselves because they generate their own money versus going out and borrowing it. That's one of the biggest reasons we see the inflationary pressure on growth companies.
Okay. Second one, I've heard that the lower valuation multiples of value stocks might have something to do with how they perform during high inflation. Can you explain how this works? Okay, so maybe piggyback on that one. This is a little bit more technical, I guess. I'm not going to get into the weeds of it, but a lot of it also has to do with that inflationary and pressure. You look at the way valuations are set. So you look at the price to earnings and stuff. All that's forward looking. So if we're going in there and looking at what the expected earnings are from a company, versus the price and looking at the discount factor. So if a growth company, let's say, for instance, we're looking at, and we project their earnings out, but we also look at the discount factor getting higher because interest rates are higher, then that's going to reduce that valuation. And so that's one of the things that kind of plays into that
Also, because again, it's forward looking. So what happens is when we look at inflationary pressure and assume that's going to continue for some time, that discount factor is higher. Whereas a value company, the cash is on hand. A lot of that's already built in there. You know what's happening. Versus a growth company, you don't necessarily know. It's all forward projections. And so those underlying numbers change, which in turn changes that valuation.
Thank you. Just this last one. How exactly does the income that value stocks can generate help in situations where inflation is high?
Okay, so these are all kind of similar. I kind of, like I said before, the dividend getting paid out, that's going to show you that a company's got cash on hand. They can typically weather the storm a little bit better. So it's not going to mean that if the market's going down, they're not going down. But let's say we'll take last year as an example. Like I said before, maybe a little bit off 1% or 2%, but growth was down about 30% in 2022, and value was down about 7 or 8%. So again, they were both down, but down by much less because again, not 100% equal to the cash on hand, but because they had cash on hand, they were able to weather the storm better. And the perception of people seeing that moved more from growth towards value, because everybody's a lot of times people are going back and forth between these as well. So, but we focus on that long-term strategy instead. So you got that aspect of it. And then also, if you look at it from a personal standpoint, if you're getting paid a dividend, let's look at maybe ExxonMobil for an example. When that thing during the pandemic was dropping down to the 50s, 40s, even to the high 30s, that dividend didn't change. So the dividend yield went sky high. I think it went up to 8 or 9% at some point. But so people were still getting that check coming in. So it allowed them to necessarily not jump ship and sell that company. And they were able to enjoy the rebound that's happened since, up over $100 a share now at this point. But that same dividend, that same cash has been coming in each time. So a lot of times that personally, if you're getting a dividend, you're collecting it, it allows you a little bit more safety, and it allows you to avoid knee-jerk reactions. That's the biggest issue we see is people are doing things on their own and the market swings one way or the other. They get in or they get out. And you can try and chase value and growth all day long. You can try and chase mutual fund managers, but a lot of times we'll see the steady, slow and steady wins the race on this as well.
All right, Wesley, that was all the questions that we had.
Okay. Well, I want to thank everybody for joining us today. A quick reminder, I think as you mentioned it before, but again, we work with a lot of different Fortune 500 companies. So if you have questions on yours specifically, just give us a call, 1-800-900-5867. But also keep in mind, even though we work extensively with some of those companies, does not mean we're employed by them or endorsed by them. But any questions, we can definitely dig into that, get you that complimentary cash flow analysis, and then help you on the review. All right. Thank you.
Thanks, guys. Have a good day. Thank you, Wesley.
All right.